and gentlemen, how do you do? I'm your host, Seth Julian, welcoming you to today's morning briefing, and it's a grim picture out there. The world is starting to wake up to the fact that we're hitting the skids. We're going to hit the wall soon. The interest rates in the United States are rising and rising rapidly, and they're not going to return to anything close to 4% soon. It's going to end the year probably above 4.25% and go well into 5% next year, which, by the way, I hasten to point out, is close to the long-term average for interest rates. Now, one of the indicators that interest rates are likely to continue to rise is the fall off in stock prices, and this is a well-known correlation. As interest rates rise, people get fearful about taking their risks and buying future profits, which is what you do when you speculate in the stock market. So they take their money out of the stock market and put it into higher returning assets like their bank account. They don't have to listen to their broker or listen to signals. They just put their money in the bank and collect increasingly higher interest rates by doing nothing. So take a look at this. This is a chart. This is a conglomeration of the indexes around the world. The NASDAQ, the CAC 40, the Milan, the Nikkei, the S&P 500. These are steep drops, and they're continuing every day. This is not a stock index. This is an index of the U.S. dollar strength, and this is actually interesting in and of itself. The dollar just continues to get strong. It's taken a little turn back the last 3 of the last 4 days, but it's going to continue to get strong as the interest rate continues to increase. The Amsterdam, the Singapore, the FTSE is falling like a rock. The Dow, even the mighty Tadawul, the Madrid, the South African, the stocks, Euro Stocks 50, and the DAX. And I hasten to point out that the winter energy crisis has yet to strike, which is going to strike fear not only in the hearts of investors but the citizenry at large. One last piece of grim news I'm going to show you, if the point isn't already clear enough to you, is the bonds. We sell 2 bond products here at the house, the Euro Bund, which is the German government 10, and the U.S. 10-year note, which is the U.S. government 10-year bond. And these declining charts show a declining price. It means that people are selling them off like any other asset. When they sell off, the price goes down. Unfortunately, due to an uninformed commentariat, you'll often hear bond yields are up. It's vaguely sounding positive. It's not. When prices of the bonds fall, the yields on the bond, because they're fixed, go up. So when you hear rising bond yields, think falling bond prices. People don't want these bonds because they're bearing too little interest compared with the actual current interest rates in the banks, and these are older bonds that are bearing older interest rates, which are lower, therefore their prices fall. We do not anticipate any major change in these trends, ladies and gentlemen. These are going to be with us at least for another year. As the energy crisis bites Europe, as interest rates affect all world currencies and all economies writ large, this is a trend that's got real legs, and we think is going to stay in trend for some time. So, ladies and gentlemen, our message to you is sell the indexes and sell them short. This is your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.